turnaround Tuesday, first Fed day. Big action tomorrow. How's everyone doing today? Good morning, good afternoon, good evening. Global citizens of the world, traders, speculators. That cleared my eardrum out. Okay, listen, just a thought here in the gold. We had this last week, something I liked against the throwover line. This is the throwover line. You could see how significant it is. I mean, we keep holding it. I think there's potential, for another move, maybe similar to what we had here after the Fed, especially if they, market interprets it as being pretty dovish, where we could go from here to here. And then up here, I think it'd be a good short, failing rally. So looking for gold to rally up to this level. Also, if you get a breakdown under 1490, you're talking about 85, $70 break would take it to 1420. A lot of people have 1420 targets. And if we rallied up to here and you had equality, that would be 1450 down here. But if you get a fib extension, it could take it down there. So thinking gold blows one more time. I'm not an Elliotician, but I like this red line. Take a picture. Hi, Cheryl, Brock. How's everyone doing? Euro did exactly what it had to do, held 61.8 back here. Tried it a few times. Initial target's 40. We get through 40. Then I think we could start challenging the highs after the ECB. And we get through here, 110.90. I think you're talking 112 or so. Anyway, Euro leading the way. That's usually the way things are set up for a weaker dollar. Let's see where the dollar is right here. Dollar could be a fade after this bounce that we've had. I know a lot of people are still saying new highs. That may not happen. And also with a little bit of risk off, look at this glaring divergence in US dollar yen. Everyone see it? Confirmed high, huge Mo, 82. This high right here, first divergence. A little bit too much juice over 70. And look at this high off the week opening we had yesterday. So I think the yen could be setting up for a pullback to 106.90 to 106.50. We'll have to close back under this breakout to declare an acceleration to the downside and the downtrend resuming, in my humble opinion. And then here's S&P. Picture really hasn't changed. This looks pretty weak so far off the break that we had from Friday. The recovery we had yesterday almost looks a little bit like a flag, but they could use it with the Fed. Here's your first line in the sand, 29.75, which was a 78.6 level here. And this is really the big level, because look at the resistance that was cracked at 29.40, 29.40, false breakout here, 29.40. You start getting back under 29.40, I think you could declare that the correction's beginning in earnest. And what else did I want to show? The most important thing to show is our promo. So listen, I know that I work with these guys. I wouldn't bum steer you. Anyone that knows me, I can't sell anything I don't believe in. It just, doesn't go with my nature. And I really believe this is the best group of people I've ever been part of a team with. And you have some nice deals here. I think this runs for another week or so. But this is, I believe, our best promo of the year. So sign up, check it out. And, it's a great website. And you're going to get a lot of content. You could go into work with Amanda, the private chat. excellent community. Surround yourself with people that do this for a living, especially if it's an avocation for you. And I don't think you're going to find a team of people that have a heart and are rooting for you and not just looking at you as being replaceable. We really pride ourselves in retention. And the reason we have retention is because people know we're giving it our best every day to build you up, edify you, and share our ideas, etc. Good morning, Blake. How are you, buddy? Day before fireworks.
Good morning.
How's it going, bro?
Man, it is a quiet night. Quiet night.
Yeah.
It's
Day before the fireworks, right?
Yeah. Everybody's just kind of waiting for tomorrow. It actually forced my hand to look at a couple of cross rates. But before I do so, let me join you in saying that, yeah, guys, if you haven't taken advantage of the seasonal offer for ForexAnalytix, make sure you do so. I'll repeat what I guess I don't know if I said it yesterday. I can't remember if I said it yesterday or if I said it on the week ahead video. It all gets a little blurry. But
you've said it before.
I probably have said it before. But what we offer for the price that we offer, it's pretty spectacular. I mean, having the analysis, having the chat rooms, having the patterns in play, just giving you some fresh ideas in the market. Whether you're you're looking at the patterns in play that are active, or if you're just looking at some of the analysis, like you go,
the push alerts can also save your ass.
Yeah, like here's some basic technical analysis for the dollar Canadian, intraday, or what's happening with the dollar Mexican peso intraday. You have some analysis that pops up, and it can give you some fresh ideas of things that you're not even looking at. And that's what I use our chat room for. Matter of fact, I'll talk about one of the traders here in just a second that's in the chat room, because it brought a cross rate to my attention that I'm going to actually start watching today. But that's what ForexAnalytix is all about, is getting the analysis to your to when things are updated, intraday, getting those charts, the analysis right to your fingertips or your desktop, and then also being able to see when certain levels have been breached, certain support or resistance levels have been hit. These will turn different colors, like you can see the DAX when supports hit, and then you can see what further support levels there are, what the analysis, corresponding analysis might be telling you, and you can always go back and say, all right, well, why is it rolling over? Oh, here it is, and here's the analysis to coincide. Those are the types of things that make ForexAnalytix valuable. And remember, for the price, I mean, you're talking $100 and some odd dollars a month. All right. Or with our discounts, I think even lower than that. But at any rate, you have a mobile app, you have all the analysis in your fingertips. Then you have our chat room, where traders, and if you want to know how to get to the chat room, it's right here. It's this little icon right here. It takes you over to the chat room. I'm already in it, so it pops that up, so you can see chat room actually is like that. So you guys can see everybody in there chatting. There's Polly and Amanda and Stelios and Paul and Nidish and Costa and Benedict and Madeline. And speaking of Madeline, and there's Michael. Sorry, I know you guys like to be on Jumbotron. There's Benedict right there. I'm going to talk about an idea that Madeline brought to our attention this morning. Nidish was talking about it as well. Was about the Aussie New Zealand. Now, as you guys know, I've been bullish the Aussie New Zealand for a while. I did a Real Vision video on the Aussie New Zealand back, I want to say it was a couple of months ago, right when we were here. Was it in April? I have to go back and take a look, because I don't think it was in August. I believe it was, spring that I was looking, spring, early summer. I was looking for a move, up, towards 108, where we're at right now. But my argument was at the time was the interest rate differentials between Australia and New Zealand, and a lot of China's, this trade war was going to be priced in, and I forget the whole entire argument at that time. But anyway, I typically like to play the Aussie New Zealand to the long side. That's my my MO is, I like to play it to the long side. However, I look at it right now and I'm not so interested in playing it to the long side because we've pushed some boundaries as far as resistance goes. We're up at some pretty key fibs, and I'm like, I'm not so interested in picking it up here. But Madeline had pulled up a chart, and I guess Nish was talking about it earlier. But the fact of the matter is she was looking at something that I wasn't. And, so if you take this, like this high right here, you go through, these spike highs, you got your resistance that we come into. Also, if you look at, this, we've got some, decent support coming through as, a channel support. So we reached overbought intraday, 4 hour, it's, trying to work off some overbought signals. Daily is overbought. We're, possibly got a throw over on the daily chart as far as resistance goes. We just had the RBA meeting minutes, which were, a little bit more, dovish, and that's going to keep the Aussie probably contained. Then we have 127% extension of this move. This is something that I was just pulling up myself. 127% extension of this last down move coming in at 108.50. Then you have the 618 of this move. Now you could look at the spike low. Whoops, that's not what I wanted. Let me delete that. You could look to the spike low here. Back in January this year, you could go, oh, well, the 618 is right there. Or if you dismiss that because you're like, well, that spike low really wasn't valid, and if that's your argument, that's fine. Just because it did happen in Asia, and it happened like at, I don't want to say 7 or 8 o'clock at night in the East Coast. So it's in the middle of the dead Asian session. It's actually before Asia really opens, we had all that, very illiquid movement. So if you go, well, I just don't want to really look at that price, and I just want to mark the low here, you could do that as well. Regardless, you got the 618 that comes into play, like right near current levels. Fact of the matter is, we're probably up against some pretty key resistance. So, she was talking about how she was looking for a short up here. And you know what? This is something that wasn't on my radar before today, because I'm like, I don't want to really deal with it on the, on the long side, because I believe it's overbought and it's up against resistance. What I was seeing is resistance. But knowing that we have the FOMC tomorrow, and I don't want to deal with really dollar pairs going into tomorrow. I could look at playing at some cross rates like the Aussie New Zealand, and this is not a bad option. But see, I wouldn't have actually known that unless I was in the chat room chatting with other traders that are, focused in the currency market. And look, this is, I'll just give you an example. This is our chat room, and I want to show you how active it is. So if you go back to when when I first came in this morning, which would have been, I still got to keep going. Okay, so 3:30 a.m. my time, somewhere around here is where I came in. I said, good morning, everyone. And this is all the chatting that's happened in the last less than 2 hours. We were talking about the euro, the Norwegian krona, the euro Aussie. We're talking about that, the big bear flag in the US dollar, Norwegian krona, and why that might be, something. There's the Aussie New Zealand. Here's Steve put in the euro Swiss. I mean, these are things that, if you just think about like the last 2 hours, even before you came here to the face webinar, we've talked about a lot, and that's how active our chat rooms are during the day. And everybody in there's really, the thing I love most about our community is there's no self-promotion, there's no promotion of any kind. We don't tolerate political talk unless it's talking crap about the Greek government. That's the only thing that's allowed there.
The previous Greek government.
No, even the current one. No, I don't care really. But we don't tolerate people being jerks either. Everybody's very cordial to each other, and we talk about ideas, and no one talks down to each other, and that's important in a community, and we don't tolerate it either. And everybody is very professional in there. I mean, yeah, we do joke around from time to time, and we might put in some funny pictures, or when things are really slow. But the point I'm trying to make is it's a great community, and that's where you're going to find a lot of ideas, and it doesn't all lie in ForexAnalytix, but I will in the analysis. But I tell you what, a lot of the ideas that I get from the chat room, I'll put them out in ForexAnalytix, and I'll do my own analysis and say, hey, Nitish in the chat room saw this chart and it was really good, and I'll push it out via ForexAnalytix. This way, people that can't be in the chat room because they're at work, or they're taking their kids to school, or whatever the case may be, they can have that analysis delivered to them via mobile on the ForexAnalytix app at that time. So those are things that I think that make this community really great. And again, it's the value proposition here. Yes, we are light years cheaper than what you're going to get anywhere else, especially based on the technology that you get, and considering we wrote everything from scratch and built everything ourselves. This is not a canned product. Not, our app was built from scratch. The platform that you see here, with Steve and his development team, have put all this together. It has not been an easy venture, but we wanted to make it available for everybody out there. And the reason why I'm talking about all this morning, guys, is because the market's super slow between now and tomorrow. But I wanted you guys to know how we use ForexAnalytix and how I use it as well. Okay, so with that being said, let's see if there's anything else. Well, with that being said, make sure you guys take advantage of the season offer, because you're not going to see a decent offer for months. Okay. So this is the time that if you were on the fence and you're thinking about, oh, well, I'd like to try it out. Well, this is the time you should, because it's the best time to do so. A couple of things I want to mention here is I want to look at the S&P. The S&P is really at some key, what I would consider some very key resistance now, because what we're trying to do is we're trying to forge a lower high. Now, I'm not saying that we can't get a U.S.-China trade deal, and the next thing you know, the S&P is trading at 3,100. No, I get that, and that could happen at any moment. I mean, we're one tweet away from that happening. Excuse me, but technically, as of right now, what we are dealing with is we're dealing with a slightly lower high or a possible double top. We are in a very tricky time seasonally in the markets. What I've always realized, and what tends to happen, and every year can be different, so you don't look at 1 year and go, well, every year during Christmas, we get a rally. Well, in risk, yeah, most of the time we do, but not every year. And same thing, like I look at this time of year. Usually, when we come off a summer break, stocks rally for the first week or two, and then the markets usually get a little heavy going into October, September, October. Okay, into mid-September, October, sometimes into November. So we are in that point in time where the markets have rallied at the beginning of the year or the beginning of the trading season. They tend to get heavy around now. And, there are things that are happening right now. We're seeing this, like the liquidity shortage. Repo rates are kind of going through the roof. It's a very, very popular story that's been going around the last couple of days. And maybe I'll have Stelios or Steve talk about that here in a few minutes. But we're seeing that percolate. And that's, that could start to weigh on risk appetite or risk sentiment. You could also see that, crude oil prices surging, 14% yesterday. That's going to have an impact on consumerism moving forward, especially if crude continues to hold, at these levels. You have now tensions that are raising between Iran and the U.S. and Saudi, and then the Middle East. You can just say in the Middle East in general. That is likely to ignite a little bit of fear in the market. So the reason why I'm pointing all this out is because if stocks start to roll over, what's your defensive plan in the FX market? Like for me, I look at the US dollar Mexican peso as being a, nice, viable candidate to be long dollars and short emerging market currencies. There's a dollar funding crisis, great. The dollar is going to rally. If there's a dollar funding crisis, great. Stocks are going to come down. Emerging market currencies may come under pressure. The dollar Mexican peso is poised to rally back towards 20. We stalled at the 618 retracement here. You look at the dollar yen. The dollar yen, remember the dollar yen is not so much the dollar, it's more the yen. But we're back at the 78% retracement. We challenged these highs. We had a false breakout overnight. If the dollar yen gets back below 108, that's going to signal that the stock market is probably trading a little heavy. So, those are just things that personally I'm looking at as, as possibilities just going into the next couple of days worth of, into the next couple of days of trading, especially with the FOMC coming up. Some of the other dollar pairs like your euro dollar, the pound, might be ones that I stay away from for the next 24 hours, but the yen pairs and maybe some of these emerging market currencies might be a better place to be looking, and some of the cross rates. So just some food for thought. Now, Stelios, Steve, good morning, gentlemen.
Good morning. How are you?
Hey, so good morning, guys.
By the way, your Real Vision video was 4th of April. I didn't want to interrupt you before.
Okay, thank you. So I knew it was just before this move happened. So it was right here. 4th of April would have been right as we pierced this trend line right through here.
To be fair, Blake, 4th of April it was published, so you need to take out like 2-3 days, because they always shoot the video at least 2-3 days earlier. So probably you shot the video like
on the first. I remember it was the first. Yeah, because I had a camera crew come to my home. So yeah, that's right. It was like on the 1st of April. It got released a couple of days later, and I was already breaking out. So yeah, and that was off of these lows. So and thank you, Steve. But I wanted you guys to talk a little bit about this story that's circulating about repo rates, and we're seeing a spike in that, and it was the most read story on Bloomberg yesterday. So let's talk a little bit about what's happening, Stelios. What's happening with the repo rates and this dollar funding issue that we're seeing?
So this could be something important because for people who don't know, the repo market is basically where banks go and fund themselves. So they offer securities, overnight securities, and investors buy them. And the banks then agree to rebuy them the following day, plus a percentage, which is what the investors make. So this repo rate is usually very, very close to the Fed funds rate. and it represents how easily a bank can fund itself. It's a bit like LIBOR used to be for ages. And what we saw yesterday was that the overnight repo rates shot up to 6 or 7%, something like that. I think in the end it settled at 4.5%.
Wow.
But the actual number, the day before was I think 2.2 or something like that. So this was a big move. And what does it show? It shows that the banks had some trouble in getting funded. Now, why is that? There were a few reasons. It was corporate tax day yesterday, so there's always an increased rate there. And also there was a lot of issuance falling on that day. So I think there was maturing debt which had to be refinanced. But anyway, there were reasons for this to be higher, but not this high. And this reminds me, back in 2008, when I was trading in London, it was at the beginning of the crisis, you did see a spike in overnight repo rates. And so it can be a canary in the coal mine. I don't think it is the same as 2008 now. There are reasons for this, but it just shows a general difficulty in funding. How much can it persist? I don't know, but this is what yesterday is telling us.
And doesn't that put a little bit of puts the Fed in a little bit of a box here, because then they might have to lower the IOCR,
whatever the initials are,
yeah, whatever the acronym is, they may have to lower that, going into Thursday. So because they need to lower rates and make sure that funding is available to bigger banks.
So everyone running to hide their car, that's not the repo rate we're talking about.
Yes, it's not fearing the repo man. That's correct.
I think what's going to happen now is that it's actually a good segue to take us to the FOMC, which is coming up, because the other thing which I've been hearing quite a bit is that, oh, look at the oil prices, they're rocketing sky high, and how are the Fed going to cut into that? Well, you have to think about, first of all, why are oil prices going up? And what's the underlying reason? And it's, we know why they're going up, because obviously of this drone attack. But the thing is, from what they say, in a few weeks, maybe a month or two, everything's going to be back to normal. But what do you have behind it? Like Dale very well said yesterday, who's doing this? What's the geopolitical implication of all this? It's I think that's this reason why oil prices are higher is probably a reason for the Fed to cut rather than to, it's a dovish thing. It's not a hawkish thing. So I don't think the Fed would take this. Yeah, I don't think they're going to take these short-term higher prices as a reason to not cut. And we have to look at what the market's pricing in terms of...
They would take them into account, though. I mean, they would take any short-term move into account if it helps the rhetoric, because, we've seen that twist in everything. For example, I remind you, Stelio, one example, when the CPI rate is higher than target, they're like, oh, we don't care about the CPI. We care to look at the core CPI. Now that in the previous reading, we had a core CPI, which was 2.4, but, the nominal CPI was lower, nobody paid attention to the core CPI because, it wasn't fitting in the rhetoric. Yeah. So, the same thing with oil prices. Now that the spike is not, does not fit the, we want to cut, a direction, nobody will mention it as a possible, indication of increased inflation. If for some reason we had some kind of an event that, created like a big dump in crude prices, like $5 down, I bet you that they would mention the deflationary possible effects from that, even if it was something short term.
Yes.
So we have Canadian manufacturing sales coming out in less than a minute. I'll just stick around and just keep it on the screen as it's being released here. But guys, I want to thank you for all your comments. I'm going to turn it over to you just as this data comes out. Let's let the data come out first, and then I want to remind everybody, hey, make sure you take advantage of the ForexAnalytix seasonal offer. Come join our community. It's a great place to be. It's a safe place. That's what I originally wanted it to be as I left Ally Financial, was to have a safe place for all of our traders that have been with us for years and years and years, a safe place for everybody to reconvene and talk markets. And that's what we've created, and we've done a really good job at it. It came in a little weaker than expected.
Weaker.
You see the spike up in the dollar CAD as the manufacturing sales were a little weak. So, so guys, thank you very much. I hope to see you in our chat room. Those of you at home that are listening in, and Steve Stelios, Coach, I'm going to turn it over to you.
Have a good one, Blake.
Thanks, guys. Have a great one.
Boring market day.
Yeah, exactly. Have a great one.
Thanks.
You make it interesting now, Steve's plural.
Actually, I just want to finish up with the Fed.
Go ahead, Celio.
I'm fed up with the Fed.
Yeah, I'm fed up. Yeah. So we have to. I was saying we have to see what the market's pricing for the Fed meeting now this week. And if you remember, it was pricing over one cut a month ago.
Do you want me to show it for you really quick on Bloomberg?
You got the Blake's
whatever
got the
you want. Yeah.
plot.
Yeah, here. I'll just do it really fast. And then I'll give it back to you, Steve.
I'm actually curious to see what Bloomberg has, because there's a tool on the CME website which is showing that the implied probability is like 65% of a cut.
Show us your Ferrari. Show us your Ferrari, Blake.
There you go. There's your cut probabilities, 100%, and we've got 94.7%.
94. Okay, that makes sense. There's a tool on the CME website which is showing it as 65%, which I did the calculations on of the Fed Fund futures. I was getting something like 90%. So okay, that makes sense. But okay, thank you for that, Blake.
You're welcome. All right, guys.
What I wanted to say is that what I wanted to say is that we were pricing a bit more than one cut. Now we're pricing a bit less than one cut. So the important thing is going to be obviously what the Fed say. The cut is going to be delivered. That's, I think, 90% chance is a good indication of how likely I think it's going to be. But what are they going to say? Is it another just adjustment, or is it going to be something bigger? We'll know very soon. A couple of other things I wanted to mention. We have today in the UK, obviously we have to have an installment of the Brexit saga. There's the Supreme Court is going to started a 3-day hearing for the decision of Boris Johnson to suspend Parliament. Let's see what they come up with, if they deem it to be legal or not. Talks between Boris Johnson and Europeans are progressing, and it's been cautiously optimistic, I think. So let's see what that brings. And but everything we have to take with a pinch of salt, because until there's a firm move of one way or another, I think we have to be cautious.
What's it take in Europe still on this missile attack, possibly by Iran? What's the European Union thinking here? Is there talk about retaliation? What are you hearing over there on the other side of the pond?
I think the main people really involved in this are the Americans, as always. I think Europe is taking a step back and see how this develops, because we know how the Americans have an interest in that area.
Well, I mean, it was just a week or so ago, Macron took the step during the G8 meeting to bring in the Iranian foreign minister. And there was like détente there, and it looked like he had persuaded President Trump to turn to diplomacy. And then Bolton was fired, and now this is going on. I'm wondering, I think Macron is the French are playing a big role in this thing. I was wondering if there was anything happening.
Justin,
I haven't seen anything yet. And I mean,
guys, Justin, I read your message. I've already forwarded that to the IT team. It's probably some kind of a glitch. They are on it as we speak, so it should be fixed within a few minutes. Okay.
Thank you, Steve.
Go ahead, guys. Sorry.
I mean, we haven't last day or so. Ever since this thing happened, I haven't seen anything major from the Europeans. I think they're taking a step back and see how it's going to evolve.
It's weird. It happened Saturday, I think, and you really didn't hear about it in the U.S. media until like yesterday afternoon, a day or so after. Kind of weird.
Interesting.
Yeah. Okay.
Anyway, let's see. That's it. I don't think we had some not minor. We had some ZEW data out of Germany. It's interesting because current conditions was quite a bit lower than expected, worse than expected. But economic sentiment for the next 6 months is more optimistic than expected. So isn't that the human nature?
But that plays zero role because as employment, for example, we know that sentiment is a lagging indicator, always has been. We usually see the highest readings in sentiment just before an economy goes in a recession.
Yeah, absolutely.
So that says it all. I mean, it's one of those indicators that I really pay no attention to. Although I found it to be decent as a contrarian indicator. When you are in a recession or whatever, usually you find also, the lowest readings, just before the dawn, you know what I mean? Yeah. So, but it's definitely not an indicator you can work with. That's the only certainty. Okay, Stelio.
Okay, that's it from me. Yeah.
Okay, thank you very, very much,
Thank
Coach.
you, Steve.
Any requests, since, as we've said, we know that the market has been rather slow, although I do have a few things to show. Just want to check if there's something you want us to look at specifically. Okay, let me know for some reason if I can't hear Dale, because with my MacBook sometimes my headset does some tricks. I'm still waiting for Gigabyte to send me my graphics card from the US. Okay, so let's begin by having a look at the metals. One of the reasons I want us to have a look at the metals. Oh, yeah, I just see your question, Frederick. Yeah, I would begin by that. One of the reasons is because it's 100% certain that the metals are going to be seriously affected by what happens tomorrow with the Fed. Okay, there's no question about it. So let's go gold, silver, and the rest, and then we'll go back to FX. I do see some worth mentioning things in FX. Unfortunately, most of them currently, besides the Aussie Kiwi, which Blake covered in detail, so there's nothing I can add there. The rest of them include the dollar mostly. So that means, if you're willing to take some of those setups, you have to be willing to take, the risk of volatility that comes with them tomorrow. Now, regardless, gold. So far, I do see this rebound as being corrective in nature. Corrective meaning counter trend to the correction. So let's not be misunderstood here, right? I'm still looking higher for gold and silver, but I'm not looking higher from here. So, from a technical perspective purely, and if I totally ignored what's, the impact of the Fed tomorrow, I'm not saying that technical analysis can predict, a fundamental development, but it would definitely bode well if we saw some move lower tomorrow in gold. I do see this rebound as being more or less corrective, and I think a continuation lower is a likely scenario. I would be very interested in buying gold lower. I'm still short, by the way, and I'm in the money. So obviously, ahead of tomorrow, I'm going to protect my position. I don't want to, from profit to go in, in negative. Obviously, I'm not going to let that happen. But I'm willing to keep that position and see if the Fed is going to help. Now, if we break below this 1485 area, where would I be looking for next area of support? You can never ignore the 61.8 of that last move higher at 1460, but personally, I doubt it that that's going to stop price action once we break below there. So I would be more willing to look, for a reversal higher closer to 1420. So that's the area I'm looking at. Now, having to do with silver, let's pull up silver. There it is. So having to do with silver, a decent reaction yesterday, but first of all, we still remain below this ascending channel. You can see that here. Second of all, I think there is, some price action missing. I mean, even if we assumed that, we had one leg lower, we had that rebound that took us to 1850, and we have one more leg lower, I would expect that leg to be longer. So, I would like to see silver back to 1670. Don't forget that we also had this trend line from which we broke higher. That trend line was roughly at 16.5. So, even back to 16.5, not unlikely at all. I mean, if you judge how fast we came down from 1960 to the Friday, we closed at like 1740, below 1740. I mean, that's $2.2 lower within, what was it? Less than 2 trading weeks, right? So, going back to 16.5, 1670, doesn't look like, it's hard to happen. Now, so gold and silver, this is what I'm looking for. On the other hand, you want to be long palladium, probably this is the area you want to be doing it. As we were saying last week, we broke above this trend line. Look at this pullback. So far, this pullback is very orderly. We've come back to retest this broken trend line resistance. At the same time, this same trend line can be the trend line. I can actually completely delete that because I drew that by hand, so it's not even straight. And we can transform this to a green one, and you'll see that this looks like a nice cup and handle formation. For those of you that don't know, cup and handle formations are continuation formations, right? Textbook continuation formations, actually, right? Because we see a pullback, a corrective pullback, then we retest more or less the previous area. Then we see another pullback, but in this case, bulls step up earlier, which means that there is buying pressure that has increased since the previous pullback that we saw. And then once you get a legitimate breakout, usually that's when you see an acceleration. So we're back testing this line. So for some reason you want to be long palladium. This is the place here that you might want to do it. Okay. So I have to say that from a risk reward perspective, and following the trend, because in this case you're taking a trade that's with the trend. I didn't expect that it would go there because I saw this price action unfolding initially in quite a corrective manner, and so far I have to say that I'm not really persuaded by looking at the structure, but it is what it is. I mean, we did go to new highs, and if we see a pickup in momentum to the upside, I mean, I wouldn't be buying it here, but to be honest, if we break above 1620 and we start doing that like in a day that momentum picks up, then I have everything I want to see here to say, okay, yeah, this is a cup and handle formation. We even rested here for 3 days. We retested the trend line, and that's it. We're headed higher. In which case, you have an implied target at 19, whatever it is, like 1930, plus. You have a 161.8% extension of that corrective move lower at 1830. So, upside targets are decently far away, which means, there can still be, decent upside for you to make a killing. Now, having to do with the recent move in crude. First of all, I have to say that the fact that crude hasn't really pulled back, I mean, even the pullback we had initially yesterday, we retraced somewhat. At some point we were like at 60 and change, and we closed higher on the day, and today we seem to be consolidating in an inside candle. We might get to see more choppy price action here, but I have to tell you the fact that we didn't leave behind a long upper wick is definitely quite a bullish statement from the market here. Okay, we did stall at this horizontal resistance area, and yeah, there's no real risk reward for you to be buying here against that resistance, but I have to say that it looks to me like a legitimate breakout, and I don't care if fundamentally speaking we should expect the the basis of this to perhaps go away like in a couple of weeks or a little bit longer than that. Sometimes the market is going to do what the market wants to do, irrespective of what was the initial trigger for that move to happen. So, for example, if we have like a very dovish Fed tomorrow, and that produces quite a bearish reaction to dollar, I mean, that's definitely going to help crude sustain its recent gains, perhaps even accelerate higher. So, you know, I don't care if the initial factor that created that was a supply disruption, which it was. You know, I still have to treat it as a breakout because that's what we got. So 63.70, it is a resistance, no question about it. Now, where would you buy if you saw a pullback? You know, you can even attempt this previous high at 60.87. Otherwise, which I find it quite unlikely, 58.90 would also be 58.80, 58.90, but, you know, less likely to see a retracement there. Not impossible, but less likely. So crude has broken out, and I think we need to respect that and, you know, treat it as bullish until proven otherwise. This is also an extra reason for me to be looking, you know, one of the pairs I think that will benefit mostly if we get a dovish Fed tomorrow is going to be the USD NOK, because it's going to be a double whammy. It's going to be negatively affected because the USD should move lower. At the same time, that's going to prop up crude, and that will help extra the NOK overperform the USD, which means USD NOK, you know, pushing even lower than it would otherwise. So 893, quite an important support area. Previous low here, as you see, there's even an alert we placed here, a price alert. I want to be short below that level. In all actuality, I would have already sold the USD NOK and a decent amount if it wasn't for the Fed tomorrow. So if for some reason we didn't have, you know, such a huge event risk that would affect the dollar, I would definitely already be like at least half of a position short here with a stop above like 903 or something. I'm not doing that. I'd rather sell the breakdown just because of the event risk we have. Okay. Look for 880, 882 to be the first area of support. Needless to say that if we do see the pair moving lower tomorrow, so if we see USD weakening and the pair moving lower with it, and for some reason we slice through 880, 882, I think that we're headed a lot lower than that. I think that, you know, we can easily find ourselves within a few weeks being down at the 840, which is another like huge area. So, you know, probably my preferred setup in case of dollar weakness is this one. Now, it's not that I don't like USD SEK. USD SEK looks decent as well, but as you see in comparison, USD NOK seems to be, you know, better positioned to suffer in case of a dollar weakness, but it's not a dissimilar setup here in the USD SEK, right? As you can see, it's more or less, there is a high correlation. It's more or less an inverted Euro USD. In fact, you can see it quite easily here because, is it in indicators? No, it's in compare, yeah. In fact, if we add 1 over Euro USD, there you go. You can see the correlation, right? Quite a nice correlation. You can see here the inverted Euro USD in orange. Now, one of the reasons I wanted to overlay this is not the first time I'm doing this overlay, is because recently, as you see, the USD SEK has been performing better than the Euro against the USD. That's why, as you see, it is lower than the Euro USD, the inverted Euro USD, right? So in essence, what we're seeing here is USD Euro and USD SEK. So as you see, the SEK has been performing better. That's why it's lower since, I mean, we were consolidating at those lows. And that is why it makes sense, if you like Euro USD to the upside, which it is appealing, at least from a risk reward perspective, because it also is in a descending wedge. I'm not saying it's an easy trade to take, because the trend remains to the downside for the Euro USD until proven otherwise. But if you really like Euro USD to the upside, I see no reason why you wouldn't prefer the USD SEK to the downside, my personal point of view. In which case, I think that a huge area of support to monitor here is this one, this horizontal area you see roughly at 948. Very, very soon, within a few days, that's also going to be confluencing with this wedges support. So I think a break below there, let's call it 945, going to be quite a technical development. And in that case, I would be looking for much lower prices. I think that 910 can easily be hit following a breakdown, and who knows from there. Okay, so let's delete this overlaid price. Okay, and let's have a look at your questions. Ingmar says, from Wall Street Journal, repo trades are a key component of a new borrowing benchmark designed by the Federal Reserve Bank of New York. The benchmark called SOFR, or the Secured Overnight Financial Rate, as Stelios said, it's the equivalent of LIBOR, is the leading replacement for the fading London interbank offer rate, LIBOR. Yeah, okay, it wasn't the next sentence. Yeah, that's true. That's true. And don't forget that it is a very good indicator of stress, because think about it like that. When banks are not trusted for borrowing money over a single night, I mean, when you demand a high rate of interest to lend a bank just overnight, that says a lot, right? CAD not affected by oil price. Not true. The correlation has weakened. Yes, it has weakened, but in general, it still plays a role. Let's have a look at the USD CAD, by the way, since you mentioned it. There you go. More of a mixed bag, as you see lately. But one thing remains for sure. The bigger technical picture for the USD CAD is absolutely clear. Okay, we've seen this recovery that has been taking place within this channel. Those channels are not random. I mean, you can see how many times the market has tested this channel and proved that its importance, right? I mean, 3 times, some of those times more than 1 consecutive days as support, 2 times as resistance. And we've been in this recovery since summer of 2017. So it's now been a little bit more than 2 years that we've been recovering in this channel. This price action has nothing impulsive to it. You can see it. I mean, if I told you that this is like a 5-minute chart, you wouldn't find it hard to expect that at some point you're going to see a resolution lower, right? But the question is when, right? Because, I mean, just what was 3 months ago, we were testing once again the support and we held. So somebody betting back then that, we're going to retest it, but this time we're going to break down. Yeah, based on what evidence? If you do see a breakdown, yeah, sure. I mean, go ahead and trade it, because, that's a legitimate, that's a, huge technical development. But until that happens, just, be patient, right? So I can't tell you what's going to happen here with USD CAD. I can tell you that we are, more or less at resistance, but, ahead of the Fed tomorrow, depends on what the Fed does, right? I mean, there's no chance that we're going to see, a big sell-off in the dollar and USD CAD is not going to follow lower. No chance. And no chance that we're going to see USD strengthening quite a lot, and we're not going to see USD CAD moving to the upside. You do make a point though, meaning, yeah, for example, the recent bounce that we saw on Sunday night in crude doesn't really seem to have affected the USD CAD to the downside. So in this case, the USD CAD did ignore this move. This is an extra reason, in my opinion, to be looking rather to be short the USD NOK instead of being short the USD CAD in case we see dollar weakness. Clearly, the NOK is, is responding better to what crude is doing at the moment, and is doing better against the USD during the past several days. So, I think between the two of them, that's why I don't really care what happens here. If I want to have a position, I'm going to have it at USD NOK. As simple as that. Now, if you want to be long on the other hand, yeah, you'd rather be long the USD CAD, here instead of the USD NOK. Not that the long-term view isn't bullish for the USD NOK. I mean, in fact, USD NOK has been moving higher during the past several months, a lot more than the USD CAD has been moving higher. But in the short term, it looks much more likely that the USD NOK is going to break down than the USD CAD. Speaking of the CAD, I have to say that if you have a look at what's happening here with the CAD yen, and I think Blake had that, it's in my scope for quite a few days, and I think this was Blake's chart of the day some days ago as well. Look at this trend line resistance that we're currently bumping ahead on, but most importantly, look at the 4-hour chart. So there we go. I mean, this looks like a bull flag to me. If this isn't a bull flag, at least so far as it's developing, I don't know what is. So, considering the fact that the long-term trend line.
Dave Floyd liked it yesterday too during the interview.
Sorry, I had meetings. I'm very busy these days, so I didn't stay at home.
Yeah, so he was saying maybe one more little pullback, maybe to the bottom of the flag will be 4, and then another push. So that kept him friendly risk.
Yeah,
it's going up, right?
It is very likely, but I mean, anyway, I don't know if it's going to do this.
Yeah, and then go.
Yeah, can it do that? Yeah, it absolutely can.
Yeah,
but. It looks like to me that this thing wants to break high. Even if you look at the RSI profile, just look at this. What has the RSI been doing here?
Yeah, worked off overbought without price giving up anything.
Yeah, exactly. I mean, we came down.
Did I get an A on that question?
No, you got an A+.
Wow. Gold star, smiley face. Okay. All right. All right.
So yeah, RSI came down in the middle of the range. So as far as I'm concerned, this thing is more or less ready to go, right? So it is what it is. CAD yen looks in the short term quite bullish. So as you said, Dale, can it move first down to 81 and then higher? Sure it can. But so far from what I'm seeing, I would be very, very surprised if it just reversed lower and, we started moving lower towards the lows after seeing this type of a formation being developing after quite an impulsive acceleration higher. So, it is what it is. I think the chances here for a, bullish resolution are like at least 60%.
Do you know why R.N. Elliott waved at everyone he saw passing by on the street?
Oh, do I want to even know?
Do you know why?
What kind of a joke is coming?
Because he was impulsive.
Oh,
and Mrs. Elliott was corrective.
She was, huh?
Yeah, she corrected him.
Women usually are, aren't they?
It's a stereotype. Anyway, just my only Elliott wave joke. Anyway, so.
Yeah, women usually are corrected, but that's why nature balances things, right? Because we need women to taper down our impulsiveness.
Yeah, right. Okay. Anyway, so our guest is here.
Okay.
Unless if you were finished.
It's not that a lot of things have moved, so sure, absolutely. I mean, today is the fireworks, as you mentioned.
Yeah, today everyone's waiting for tomorrow. Tom Petty, the waiting's the hardest part. So
Very, very, very true. And you know something, if you learn how to get
wait,
yourself to patiently wait,
yeah,
you're going to do much better in trading. That is why I strongly advise traders to have hobbies and, you know,
that's a good idea.
go to the gym, do other stuff, because
Yeah,
if you have hobbies and things to do, when you know, for example, that it's going to be a slow day, just go do your stuff. Or, you know, if you're lucky enough to have a big office or your office at home, you know, you can have your screens open so you can, you know, have an eye on them if something, you know, happens. You can have the ForexAnalytix, of course, sending you alerts in case something happens, and do something else so you don't feel obliged to sit in front of your computer and start taking stupid positions.
yeah. And if you play like monetary goals, if you're close and you hit it, walk away and relish it and smell the roses. Don't sit there and try and, well, you know, it's not enough. It's not enough. So anyway, good mentoring, Steve.
So, Coach, if your guest is here, I'm going to wait until I make sure that everything is working correctly.
Okay. Okay. Hello, Privateer FX. You anonymous pirate. I just made you the, oh gosh, I hope we don't have you on telephone. Are you on telephone?
No, I'm on a headset here.
Oh,
Can you hear me?
buddy. Yeah, how are you?
Loud and clear.
I'm good.
Good.
You guys did some good work there. Nice professional setup you got going. Congratulations on that. I tip my hat. A lot of different voices, which is important, and a lot of stuff covered. It's pretty good.
Well, we have a promo going. You should join. So anyway, if you want to share your screen.
Dale, you're capable of selling fridges to Eskimos.
Yeah. Well, you know.
What do I do? I click share here?
Yeah, the green box.
You click the green box saying "Sir," and then you're going to get a screen asking you, you know, which screen or which window you want to be sharing.
How's that? You see my trading view here?
Yeah.
Got it up there. So tell me, my trading warrior brother, I see this chart up here. You're looking at notes. So is this on your radar? And is this pullback in the notes an important, significant top, or you thinking a break to buy if there's some more risk off? Where's your head at?
Yeah, we think this is the main story for the rest of the year, and this is going to drive every other market is basically boons. At the long end of, you could pick your poison, gilts, JGBs, 10s.
Bear market?
It's the beginning or the end of the bull.
Okay.
Is basically what we're saying. I wouldn't call it a bear market, but I mean, rather than look at the futures charts, I think I would encourage people, and I know there are a lot of youngsters or sort of new people out there listening. If you're going to trade notes, if you're going to trade notes or if you're going to trade fixed income, you kind of have to look at the yield chart, especially if you're going to trade it technically. And it gives you a better feel for what exactly is going on. So this is the yield chart. We're actually obviously selling the futures to get long the yield. And you saw the turn down here at 150, but the turn for me really was ECB. So let me put up the boons first.
Okay.
So boons are more important. We have this negative yield, which of course is patently insane. It kind of removes the notional idea of why we have bonds.
Sure does.
They're income instruments, and people have lost. I mean, this simple fact has just been lost on this market that's caught up in this rhetoric, caught up in this ECB speak. And then it was caught up in momentum, right? I mean, CTAs buy them, it goes higher. They buy them, it goes higher. And this is just what they do. And people forget that if you buy boons here and you hold them, you're going to lose money. And so we were just waiting for the turn. The ECB gave us that turn by basically what I thought was saying, you know, this is a change in structure. We're going to go no lower in rates, and we need fiscal help. It was like a cry for help from Draghi, I thought. And he's basically saying, we lowered rates almost because we had to. We said we were going to, but we're desperate for fiscal help here in Europe.
And what'd they do? Throw confetti on him?
Well,
Remember
I
the
think,
confetti episode?
oh yeah, was that flour or confetti?
It was
That was,
confetti, yeah. And you know what? Mario, it frightened him. He ducked.
yeah. Well, that was a
I
bit
don't want
scary
him
though.
I don't want him in a foxhole with me. Anyone that's afraid of confetti, you know what I mean, Privateer?
Yeah, he's not a guy. He's not a street fighter, that's for sure. Those
Yeah,
those
those
Goldman
central
guys,
bankers, you know.
yeah,
Yeah,
ex-Goldman central bankers, pretty
yeah,
soft. I
yeah,
agree.
yeah.
Anyway,
So okay, so then this is a major shift
yeah,
because we've been. Is there? You know, I've read some interpretations that this bounce in yields could still just, in Elliott terms, just be a 4, and there could be one more shot down. The bonds took out their record low yield, and the 10-year did not. Is there a possibility that that happens? Maybe if we get some risk off in S&Ps?
yeah. I
Or
mean,
low?
of course, if that does happen, Privateer is going to take a loss because we'll be stopping out if we make new lows in fixed income.
Okay.
But our main premise here is that we've had the turn here, and especially because even if we have 200 handles in the S&Ps, which is obviously a pretty big move, we're still going to be up 10% for the year. It's no big deal. You know, we're 0.5% from the highs, from the all-time highs. So what I think is basically going to happen is, even if they cut rates, it's going to create this, the long end is just going to steepen. It's going to create this fear of inflation.
Yeah.
We've already seen a little bit of wage inflation. We saw the CPI coming out stronger. And I just think there's a mentality change now that as soon as, you know, I can just sort of sense it, the way the media is playing with negative rates and the way the media is saying, listen, this blows up Western finance. 10-year rates at 1.5% blow up pension funds. They blow up insurance companies. They blow up bank balance sheets. All of these institutions on the asset and liabilities management need to invest in income producing financial products. And when all these financial products yield zero, you create this huge, massive hole. And people are slowly starting to get their heads around this. And you're going to see, I think, central banks recognize. We've seen governments recognize it. I mean, I don't know if you saw the Netherlands, they sent a letter to the ECB saying, please, no more negative rates. You're killing us. Obviously, the Germans can't stand this. You know, they're quite good with money. They're good savers. And this is penalizing all of the good savers in the world.
Yeah, for a decade.
Yeah, and all the retirees in the world. I mean, God forbid you put 3 million in the bank and you're saying, I got 6%, 180 grand a year. Now 3 million in the bank, your yield is 30 grand.
Well, didn't these pension funds with this, what they call it, income suppression, with this going on, didn't it push pension plans out on the risk curve?
Absolutely.
So that if there were bear markets in some of the instruments they're invested in, that could really be the nail in the coffin. And I think in the U.S., the pension benefit government insurance plan is only a drop in the bucket compared to all the pension plans here in the U.S. So is it really going to be rates, or is it going to be other asset classes? Since pension, go ahead, Steve.
All that, Dale, is half the story, because the other half of the story is that, you know, from Austrian economics, in my opinion, the only school of economics that really understands what happens to the real economy, you know, low rates create what they call malinvestments. So in essence, they turn factors of production to doing stuff it shouldn't be doing, and that shouldn't be viable under normal circumstances.
Speculating.
And that is why you get all those big busts following. So in essence, not only you penalize savers, not only you draw blood from the only productive part of the economy, because don't forget that some people don't remember the most basic stuff. Investments, you know, an economy grows by investing, right? You invest in order for you to increase productivity in something. Okay, now, how do you invest? Where do you find the money to invest? You need somebody to save that money, right? What is savings? Savings is under consumption. You hold consumption for now so you can have
Delayed
money
gratification.
in the
Yeah.
future. So it's a whole vicious circle that goes around and around since mostly like the 80s, 90s, and it seems to be getting worse by the decade.
By the way, Privateer meets Steve Volge, one of the
Hi,
partners
Steve.
here.
Yeah, I think we're on the same page. I mean, our main premise about this, and the reason I bring it up, because I cut my teeth in FX. 90% of my P&L for the last 30 years has come through FX. So I'm no fixed income guru, but I do see this is an element of the market that is going, and I do think this is the element of the market that's going to cause the big risk off, because this is the portion of the market where everyone owns the dog shit. So if you think about 2008, CDOs and all of these, that was the dog shit that created the sort of crash down.
Right now it's corporate debt.
You know, here it's triple B, it's junk. It's the corporate debt that's junk that only yields 1 or 2%. It's 1.8 trillion in bonds that are negative yielding. You're basically taking a loss by owning this unless you bail out. And what people don't realize is, you know, their time is working against them. So there's just going to be this mass exodus, like it always is, you know.
Exactly.
In 2000, it was the junk stocks. In 2008, it was the AAA rated junk fixed income instruments. Now it's actually going to be shitty corporate debt, and also, frankly,
Government,
shitty
sovereign
debt. Yes,
Yeah.
I mean, who the fuck wants
Everything.
When the market at some point, and it's inevitable, will need to reprice a risk on all those instruments, it's going to be a massacre like nothing we've seen before.
Well, it's the most crowded trade, I think, in the history of mankind. In fact, last year, Privateer, didn't all that huge withdrawals or liquidation of equity funds all piled into bond funds, and the world is like it's the most crowded trade on the planet. Bonds.
Well, this is another page that you have to bring into this. And, you know, if you're doing a trade and you need a story, the story here is very persuasive. Now you just have to time it right. I'm arguing that this is just the beginning. The first inning was last week. But onto your point, you know, Dalio came up with this risk parity idea, right? So I'm going to be 4 times leveraged bonds, which will cancel out my downside risk in equities. So I'm going to have 50% of my stuff in equities, and I'm going to be 4 times that leverage in bonds. And so it's risk parity. So no matter what happens in the market, I'm going to make money. I'm going to either make income.
I have one word for that: stagflation.
Yeah, I mean, well,
because if we get, if I say if, okay, whatever the chance is, if we get stagflation, this guy is going to be losing from both ends.
Yeah. Well, Steve, this guy, let's give him some credit. For the last 20 years, he's made 20%.
No. I do give him credit. I mean, there's no question about it. I mean, he's not a random guy. But I'm saying, by saying that, okay, I'm hedged no matter what. No, dude, you're not.
I totally agree. And what's worse is, and I was coming to the punchline here, I don't worry about Ray Dalio managing risk at Bridgewater. What I do worry about now are all these Muppet ETFs that have replicated this strategy without fully understanding the risk. And the risk is not price. Anyone can calculate price. Price goes up, there's basis points, you get dollars or you lose dollars. The risk is in liquidity. And again, it goes back to the whole thing. The position size is too big for the door. And what happens to that, you know, that's when collapse happens. And so when the
like Bobby Axelrod better than Ray Dalio. You know him?
Yeah, he's on that program Billions, I believe.
Yeah, I think Bobby's pretty good.
We don't have that in Switzerland. Is that on Netflix or something?
I think HBO. It may be on Netflix. You got to check it out.
All right.
So the first inning. Let's kind of go with where do you think we'll be at the 7th inning stretch? Back to 3 1/4 on the 10-year. Last year's highs.
10 goes to 3 1/4, probably to 3.5. Boons go to 1%, which is the sort of their natural state. And there'll be a couple of things that are going to happen when this happens. So the majority of these
Weaker dollar?
investments, yeah, I'm going to get to how this is going to affect the dollar. The majority of these investments are in the US. So you're going to see for the first time, probably, and many youngsters have never seen this, but you're going to see basically US fixed income get smashed. And then so the funding costs and just the fear is going to bleed into an already nervous equity market. That's going to go lower. And so what's basically going to happen is you're going to basically see people leaving US dollars. So all foreigners who own NASDAQ, who own S&Ps, who own these risk parity funds, or who own just US fixed income, because it's the only fixed income in the world that has any kind of yield, are then going to have to repatriate. And you go, where is that money going to go? And there's really only sort of three choices, right? It either goes into the euro, it goes into the yen. You might argue it could go into the yuan, but I think that's a false argument. But let's just say it's probably going to go into the euro, because the huge insurance companies, the huge pension companies that have these investments are in Europe. Think of, the biggest German, insurance company. And so you'll see the dollar get hit, and then the majority of this, ironically, is going to go into what will be sort of this new safe haven, which is going to be the euro. And the reason it goes into the euro is they're now tightening, or at least, they're not going to lower rates anymore. They've kind of basically said that. At least in my head, that makes sense to me. A lot of people are questioning that. The US is going to have to lower rates because there'll be panic, and Powell's a pussy, and the president is screaming at him. And there'll also be a general convergence of rates. But euro rates are going to either stay the same or go a little bit higher. US rates are going to go lower. And then there's going to be this, this migration out of US stocks and US bonds. So there's three ways to make money here. I think the first and the easiest way, sort of your first derivative, is to be short fixed income.
Okay.
Then your second derivative is, and this is kind of one of everybody's favorite trades, is short equities. People love being short equities. There will be some slippery days in equities. And like I said, equities can easily go down 200 handles, and you have the 200-day moving average down there. It means nothing. It's still up 10%. I'm not saying equities are going to go down 400 handles, although they could. They easily could. I wouldn't go out on a limb and say that, but there will be money to be made.
Yeah, won't the narrative change with higher yields as far as when you're looking at
capital allocation? Yep.
It becomes, just yield. Just the competition on the yield for the market.
Correct. I mean, there's so many. It becomes like a self-fulfilling prophecy if this happens.
Nowhere to hide.
Exactly.
Except the euro.
Well, ironically, the junkiest currency that we've all been kicking, and punching, beating that crap out of, is going to be the place where the money flows to. And
160. 160.
No, 124.
Okay. All right.
I think
that's fine.
I think 116 is still fair value. I mean, everyone in America goes, "Oh, euro's going to go to 1," and 111, 110 is kind of low for us. For those of us who live in Europe, we're kind of like, people in America don't really understand the euro, I don't think, as well intrinsically as we do over here, in the sense that we opened at 116, we went down to 80, we've been up to 155.
Yeah.
116 is kind of neutral, 118 is neutral. It doesn't even get exaggerated until 125, 126. So a move to 123 happens very quickly, especially if fixed income leads this. And for me, this is how it has to work. It's 1, 2, 3. It's fixed income, that cracks the stock market, and then it'll be the currency trade. And so going into the...
I was talking about the same thing. Fundamentally speaking, I mean, many Americans think, oh, the euro is like, currency, like, oh my God, it's, who would want to be there, etc.
Toilet paper, right? Yeah.
Toilet paper. But, besides indeed some existing political risk, the Eurozone economy as an entity, so let's say the market discounts a chance of a breakdown of the Eurozone at some point. But if you're looking at shorter term, so you have to take out of this, you have to take that possibility out of the equation, because that's not like a short-term thing to come, even if it happens. The Eurozone economy is an exporting economy with a positive trade balance, with very, very, very manageable deficits, and a lot of countries, and some of the big ones, that have excellent economies. So if you compare the two economies, so if for some reason the Eurozone became a federal country, like the US, I mean, the Eurozone would be at so much of a better place than the US at the moment that it wouldn't even be funny.
Here's something you might enjoy this, Dale. Obviously, I'm American. I've lived over here for 20 years. I have European passports now. My kids are more European than I am. But here's something that I learned over here that you might find interesting or relate to or not relate to. Everyone shouts about Europe having low growth, and we do. Compared to the US and compared to China, we have low growth. But what people don't understand is in Europe, like, we don't need 3% growth. People are just happy with stability. And what Europe has is just stability. So just a tiny little bit of growth is fine over here. And we have all of these social networks and social nets for populations that it's built for stability here, whereas the US is built for growth. And people are in a psychosis in America going, we need to grow more, we need to grow more, we need to grow more, we need to grow more. But that's where the boom bust comes from, because at some point you can't grow anymore. Growing is not an infinite line. And people forget, people can't wrap their heads around the fact that if we're growing at 0.5% in Europe, the population is totally happy. Food is on the table, the schools are open, the buses are on time.
Does the U.S. need more growth to generate more tax receipts to handle huger deficits in Europe?
Yeah, absolutely. And
that's why that's the
reason
US, for it, right?
The U.S. needs to stop spending on defense or stop, that's the big problem.
Needs to return back to the roots that made it one of the greatest economic miracles we've ever seen. It needs to stop pretending that an economic model of everybody consuming money they don't have is the way to prosperity.
Is the correct way, yeah.
And go back to having an economy that actually produced. And many people don't know history of economics, but the US used to be the biggest exporter ever.
We laugh at Japanese products.
Despite the fact that it had by far the most expensive wages. Despite the fact that it had the most expensive wages.
Yeah, well, Henry Ford knew you had to pay your employees so they could buy his cars.
Let me I'll chuck some good stuff in there about wages. In Switzerland, our minimum wage is like, I don't know, about $24 an hour. In Germany, the minimum wage is like 20 euros an hour. And they still export. We export everything everywhere because we do good products. So it's not even about the wages. It's about what you said is about. It's a mentality that, America's not just chasing its tail. It's a cultural, and they need a cultural break. And one of the things that you guys said, I laughed, and this kind of apropos, without trying to, being like a misogynistic jerk or whatever. So I'm not going to use the word wife. I'll just say partner. America needs a partner, to like a practically minded partner to rein itself in. And it seems like, America doesn't have a wife. It's just the impulsive guy, is to use the metaphor you guys are using. But they need to control those impulses, I think. And I don't know if they can, and it's no big deal, because as America crashes again, which it inevitably will, it will also rebuild itself quite well. This is the American way. It goes up to higher highs than we can possibly believe, and then it crashes to lower lows that we could possibly believe. The whole world's going to end.
The rubber band
is itself, right?
The rubber band always stretches further than we think.
Right. We're in Europe. We never have crazy lows. We never have crazy highs. We just, get our fresh bread and have dinner together.
You're like EKG of someone that's in a coma.
Yeah.
We have a friend here, Ingmar, saying that German minimum wage is 8.90 and goes to 9.20 in 2019. Just a fast comment about that. It shouldn't. There should be no minimum wage in any kind of an economy. Minimum wage is not something that protects workers, is something that actually harms them. Simply put, minimum wage is a barrier.
I feel a debate coming here.
Yeah.
Oh, you can.
Go ahead.
I hear
Go ahead,
your
Praga.
cry on this. I hear your cry on this, and in a textbook that is correct. But there are certain people within every population that need a little bit of help. That probably aren't worth that $9.
Absolutely.
But they need a living wage.
Exactly. Absolutely. That is why you should let the economy function as a free market. Because if you said, let's say we set a minimum wage at €9, what does that mean immediately? It means that every person that isn't equipped enough to have a productivity worth €9 per hour to their employer, in essence, is rendered by law illegal to be employed. If you have a person with diminished skills that, let's say, can only produce €7 per hour, it's like saying to the employer, that person can never be employed. So do I believe that people that cannot make a decent amount of money to live should be helped by some economic government plans? Yes, they should. But there should still be no minimum wage. They should let the free market balance the way it wants. And then, as a government, you can, go to sensitive parts of the population and say, okay, some people are making less than they would need to have, let's say, you need to have a decent life. So let's make some kind of a program to help those people outside of what the free market does. Because if you try to regulate the free market, all you do is you'll create more employment and perhaps get some people that really want to work even for €7 per hour, do either of the two. Either work under and get paid under the table, which is good for nobody, right? Or stay permanently unemployed.
I hear your cry, Steve. I'm of that sort of libertarian mold, but also as I get older, I do realize, and there's some dignity questions within your argument that you're not really respecting, and it seems disingenuous for the three of us on this phone here. We're all in financial markets. We've all done very well in our lives. To be kind of putting on these empathetic shoes and saying, I know what it's like to work at minimum wage. If you work at a grocery store and you're only putting out €7 worth of value, you still should get paid $9 for your own dignity's sake, for the sake.
I haven't always had great times.
The employer should not be paying that. That's what I'm saying.
But then there's a dignity issue. You don't want handouts either. I disagree. The employer and the corporation has a social, social responsibility.
Yeah.
Yes, they have a social responsibility. You know how it's called in one word? Taxes.
No, I disagree. The responsibility of a corporation is to provide work for people.
As a testament to that, let me tell you what Ingmar wrote back. It's not working in Germany. Employers circumvent minimum wage in many ways. Unpaid extra hours, unpaid standby hours, you name it.
Yeah, they do that here too.
Exactly. Yeah. Why, guys? Because the market will always try to bypass clots in the circulation of the economy. And, legal obstacles are clots.
This is a good conversation. This could go on forever, but I will just say this. It's not the fault of the system that corporate guys are taking advantage of the system or looking for shortcuts. It's the problem of the people themselves, and humanity has a problem. A lot of humanity has a problem. Capitalist humanity has a problem. And don't get me wrong, I'm not a socialist, I'm not a communist. I'm not sure I'm a capitalist either, but we need to recognize that it's more than just about dollars and cents. There's humans.
Let me boil it down. 40 years ago, if you saw someone that was poor, you would say that they were poor. 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 You would say that they were poor unfortunate, compassionate, right?
Yeah.
Now it's, oh, you know, they're
Scum. Whatever. Yeah.
right. I mean, that's a big difference.
It's a bit upside down, all of
Yeah,
this.
that's what I'm saying.
And
Guys-
the textbooks.
Yeah.
Guys, don't get me wrong. It's not that I'm not sensitive or I don't love human beings or whatever. I'm just telling you that if you want to help somebody, you can't do that by enforcing laws to an economy, because the economy always has ways to bypass those. So what I'm trying to say here is the following. If you want to help somebody, you have to do it in a manner that will actually work. In essence, in a manner that won't go against human nature. Because if you're trying to regulate a minimum wage, as our friend wrote there, and I have the same experience from Greece, employers, employees, and everybody else will find a way to bypass it and illegally achieve an equilibrium that comes from demand and supply. Because don't forget, what is the wage? What is the hourly wage? It's a price. A price of what? Of one work hour. So who settles that? Demand and supply.
No,
as simple as
that's
that.
not true. That's not true.
If somebody cannot make enough to make a decent living, I'm not saying that they should be left on their own, at their own luck. I'm not saying that. But what I'm saying is that you can't help them by putting in place a minimum wage. Minimum wage, as many things, are good politics, bad economics. And usually what is good economics is bad politics. Because it is very easy to tell somebody that is employed at the moment, don't worry about it, I'm going to raise your minimum wage, let's say random numbers, from $7 to $8 per hour. They're going to be like, oh, nice. What they're not thinking is the victims of this, legal change that you cannot see. The person that is not going to find a work at all because there is no employer willing to give them $8 per hour. But there might be an employer out there willing to give them $7.
Okay. All right. Why don't we
Let's
wrap
go back
up?
to currencies. Yeah,
wrap up with some of these markets, because we could go through a bottle of tequila over this. All right. Go ahead.
Let me just throw the most simple chart and the easiest way to express this currency trade. We saw it on Friday, and I actually thought Friday, I got a bit twisted on Friday. Long euro crosses, euro Aussie, euro CAD, euro Kiwi, euro dollar, euro yen. It all lined up beautifully on Friday, and then everything got scratched. But here's the trend line in euro. You see it on it's a very simple trend line. We have 3 touches.
Yeah.
For me, it's quite straightforward tomorrow. If he cuts and is dovish or sounds afraid or is interpreted as dovish, you get long through 95, which I think was yesterday's high. You add through 10, and then you respect this trend line. Probably trade to an average, because we have, you have basically a few more central banks to get through this week. We've got SNB, we've got BOJ, we've got Norges Bank, and then core longs after we break this line. And ideally, you'll see bonds lower, the entire fixed income market lower, which is going to confuse a lot of people, because as rates, the US 10-year rates go up, people are going to go,
they would think, it should be a strong dollar.
When
it weakens the country.
Yeah. My premise is this will be outflows from the US coffers.
Yeah. Anything US dollar denominated assets, equities, bonds, whatever.
Correct.
And
that will create what you guys, I think, are talking about on the equity side, this day of reckoning. It'll clean out some of these zombies, and it'll also force just a more natural level for junk bonds, for shitty instruments.
Continuation of the bull market in precious metals with this going on?
I would suggest yes.
Okay. And energy, any view with what's happening geopolitically?
I do have a view. I wanted to bring that up. Let me just pull up the CL chart and the monthlies. A lot of people listening to this call weren't around in 2003 when we invaded Iraq. So here's the monthlies.
Oh, yeah.
Here's the monthlies.
I was there for Gulf War I.
That was what, 98 or something, or 99?
Early 90s.
Early 90s. Yeah, I was in
Yeah.
college.
Yeah.
Here it is.
Don't
right
rub
here.
it in, man.
You're young at heart, Dale.
Yeah, I know.
Here's the March 03, which was the sort of quick down and dirty invasion to Iraq. So we had the blip up, but then we had to move from $39 to $24. That's $15. That's like a 50% move almost. It's a 40% move lower.
Yeah.
Before we went higher. So I'm just cautioning people because it looks quite bullish. The players are all psychopaths. You got MBS in Saudi Arabia, you got Rouhani in Iran, you got Trump. These are sort of egotistical, sort of sociopathic guys who you don't really want at a negotiating table, who aren't really, sometimes aren't really thinking super clearly about like secondary consequences and tertiary consequences. And now you have also what looks like, you know, a Saudi patch of oil, or 4 patches of oil. So there's Gowar and 3 other ones that are easily attacked. I mean, what the hell? 10 drones? They did this much damage? Imagine if there was 100 drones, and those drones are 25 grand a pop. I mean, I know guys in the hedge fund world who would just send 10 drones because they're long oil. You know, all jokes aside, but I just want to caution people and say, even if the U.S. goes into airstrikes into Iran, which would be awful on so many levels, oil will probably blip up on that. But if that turns into a global recession and demand goes down, and it's just a tricky, and I'm not a good oil trader. I don't trade oil a lot. I just want to recognize, like every single time we're in a market, you have to look both ways. And this looks incredibly bullish. The story looks incredibly bullish, but it also looked bullish in 2003, and it dropped 40% after the Iraq invasion.
So be careful. People who buy headlines today sell newspapers.
Be careful. Leave your stops in. And I know stops are tricky and crude. Leave plenty of slippage. Just be careful is what I would say. I don't have a dog in this fight, but I can remember from 03, some of my friends got massacred on that because it just didn't make any sense, right?
You were finally out of college. Anyway, my trading warrior brother, I really had a blast talking to you and having Steve jump in. And, you know, I have the drift, really real good narratives that you presented to us today. What's the best way for people to stay in touch with you? You know, I'm not the only guy in this thing. We've got a guy in America who does our weekend videos. He runs a systematic. He's got this beautiful systematic fund that he's going to be starting. And then we also have a guy in Ireland who's more of a, you know, kind of just a media guy. I guess Twitter is the best way to say hi if you feel like saying hi. Okay. I mean, what I do in my morning videos, it's just basically a trading. It's just basically my trading book that makes me accountable. And one of my friends said, can I use that? And we'll create this channel with it. I don't know what we're going to do with it. It's just me being accountable to me. So I say what I'm going to do, and then it's recorded, and then it makes me more accountable to do what I just said. And then that's what we do. And we're like just 3 old guys who've been in the markets for 30 years. Doing our thing. But Twitter's the best way to find us, I guess. Okay, Privateer. Well, you know, may pips rain down on you and your partners during this fall season and into the Fed. And I really appreciate you bringing some very insightful views and markets that are at pretty important inflection points. So thank you for edifying our community today, buddy. Beautiful. Good luck to you guys. I wish you well, and we'll see you along the way. All right, buddy. All right, everyone, that's a wrap for Turnaround Tuesday. Everyone have a great day. Don't forget the promo's running. I think Privateer should sign up, even though he probably doesn't need to. I think he should. And most people listen to me because I have authority. Anyway, no, it's because they trust me. Anyway, so listen, everyone, don't just count your pips, count your blessings, and we'll see you for Fed Day tomorrow. Thanks again, Privateer. Take care, Dale. Be well, okay? Ciao. Thank you, buddy. Adios. See everyone tomorrow for pre-Fed. Enjoy.